We'll go ahead and move on to the third option then. We're going to talk about donor advised funds. Oftentimes our donors refer to these as DAFs. And these have been growing in popularity recently. We've been having a lot more conversations about DAFs. So Nora, if you wouldn't mind giving us just a quick overview of what this is, and then we'll hop into some more donor questions. That'd be great.
Sure. So a donor advised fund essentially satisfies or qualifies as a charitable gift, and enables the individual who's funding one to get an immediate tax deduction. Now, what's interesting, though, is that it goes into the fund that then in turn will make charitable gifts from the fund. And so a lot of individuals are using donor advised funds right now because of our increased standard deductions. So you may remember with the Tax Cuts and Jobs Act, they did away with a lot of deductions on the income tax return, and there's a higher standard deduction. So it's about $14,000 for single filers. It's about $30,000 for married couples filing jointly. And with those high standard deductions, many people who don't give a lot, they give maybe $10,000 a year to charity, they're not able to get the benefit of that charitable gift because if they're, the standard deduction is about 30, they're only giving 10 in gifts, they don't get a benefit. So instead, what those individuals are doing is saying, look, I want to give $10,000 a year away to this particular charity or to a cause, or at least to make a charitable gift. But I'm not able to do it every year because it's not giving me an income tax benefit. So instead, those individuals will do what we call cluster gifting, right? And rather than give $10,000 a year, they may give $100,000 in year one, so that, and particularly if it's a high tax year, so that year the gift is above the standard deduction and they get to take that charitable deduction for the gift. Now, the problem is they may say, look, I want to, but I don't want the charitable organization to get $100,000 in year one. I want it to be spread out to make sure that they use it properly, or because I know they're going to have a need in future years. That's where the donor advised fund comes in. You can make the gift in that year one of $100,000. You get the charitable deduction, but it doesn't have to go out to the foundation, in year one. Instead, the donor advised fund enables the individual to make recommendations or grants as to how the funds are used. And they can also say, look, if I can't make these decisions, I want my kids or my grandkids to decide how the funds are used. So it's a vehicle that you can make the gift into and then later direct the funds to come out of. And what's interesting about a donor advised fund is, unlike a private family foundation, which has to distribute 5% of the assets every year, right now, there's no requirement that a donor advised fund has to make a distribution in a given year. So, and that can cut both ways. In a way, it's good if you want to gift in the future. In another way, though, it means that it doesn't necessarily require that charitable giving. And that's one of the techniques that I mentioned that prior administrations may look at. So a donor advised fund is a really, really great tool. And we've talked about what types of assets we might gift. Well, if we had stock that was appreciated that we want to get out of our portfolio, but we know if we liquidate it, we're going to have to pay the capital gains, that stock could go into a donor advised fund. And when the charity then liquidates it, it's not incurring the gain because it's not going to be a taxable, a taxable entity. And again, business interest as well can be put into a donor advised fund. Interestingly, a qualified charitable distribution from an IRA, that can't go into a donor advised fund. That has to go directly to the charitable entity. So that's a really, really great tool. So Sarah, what kind of questions do you see from your donors regarding these DAFs?
Well, we do discuss this quite a bit, and you mentioned when you said it could cut both ways. We have heard some stories that maybe things aren't as clear with DAF. So I would ask, can the donor at any time, so say they know they want to put money into a DAF, into this fund, but they don't necessarily designate the charitable organization that they'd like the funds to be donated to or distributed to. Can they then make that change at any time? Can they put in money now and maybe 10 years from now designate where that, which charitable organization should be receiving that funding?
Absolutely. Yeah. At any time, the donor or the person that the donor designates, right? The kids, the grandkids are able to sort of change. It has to be a charitable gift from the donor advised fund, but that agreement will allow them to modify the purpose or the recipient charitable organization at any time. Yep. And that's the beauty, the flexibility of the DAF.
Interesting. Are there ever times in which the money is never able to be dedicated to a particular organization? And what happens in that case?
Well, if the organization that you'd like, the donor or the advisors would like to go to is not a qualifying charitable organization, then the fund cannot make the distribution. It does have to be to a qualifying charity.
Okay, excellent. And can you, just touching on the last thing that we covered, what are the key differences that you would say, again, a digestible way for us to understand between a DAF and an IRA?
Yeah, so and I think maybe this example will help. If an individual says, look, I want to give $100,000 to the foundation, and let's say they want to take advantage of the qualified charitable distribution. But let's say they also say, look, or maybe that's the consideration. I want to take advantage of qualified charitable distribution, but I don't want the foundation to get $100,000 this year. I want it to be spread over a few years. In that instance, the individual would say, okay, well, if I do the qualified charitable distribution from my IRA, I know it has to go directly to the foundation. I
Right.
get that tax benefit, but it's all going to the foundation in that year. So in that instance, the individual may use the QCD. Now, if the individual says, nope, I want it to go to them down the line, then the individual would be better off putting assets into a donor advised fund, because the donor advised fund can then shell out the money over the next, 10 years, or as the case may be. Because remember, but unfortunately, you can't have the QCD go to the donor advised fund. So that's a distinction between, how a client may make that charitable giving.
Sure. Okay. All right. So, and you've talked about the tax benefits of the DAF, but essentially we're not, the individual wouldn't be, they wouldn't be susceptible to the same penalties necessarily if they took from, like the QCD, where they then took it out into their personal account and then donated. It's not the same type of penalty necessarily if it goes directly from the individual to a DAF, and then
Correct.
it's okay. Excellent. Well, that's good. Is there a time limit on how long the money can stay in a DAF?
Currently, no, and that's one of the things that we may see a change in the law on. Unlike a private foundation, which has to distribute 5% on an annual basis, a DAF doesn't have to do that. So the funds could stay and grow income tax free and come out income tax free from a DAF, almost indefinitely. And in a way, that's can be a good thing, but it also can be a bad thing, because those funds should be put to charitable use. So
Yeah.
that's something that I think, if I had to bet, in the future we're going to maybe see a requirement that DAFs do make periodic distributions, but right now it's not required.
Sure. Sure. So if an individual does dedicate, let's say $100,000 to a DAF, and that does grow within time, would the charitable organization that it's meant to be distributed to ultimately receive that 100,000 plus any interest, or is it just
Exactly.
they
Yeah. So
would? Okay.
so that's the benefit. So, in a
Yeah.
way, the fact that the funds can stay in there indefinitely and grow means that you down the line, you may be making much bigger charitable, the
Sure.
DAF, maybe making much bigger charitable gifts. Yep. So
Sure.
it can go both ways.
Got it. Okay. And then what kind of assets can an individual contribute to a DAF? Is it solely cash or retirement accounts, or what are we looking at?
Yeah, no, it can be cash. It can be qualified funds. It can be appreciated assets. So the example of the Exxon stock, it can be
Mhm.
business interests, and if someone is selling a business and they think that it's going to be a quite a liquidity event and a lot of capital gains, that individual may choose to put some of the business interest into a DAF or another charitable vehicle before the sale. That way they get the benefit of the charitable gift. But then when it's sold, rather than sell the business for $1 million and say, I'm going to then take $100,000 of my proceeds and give it to the charity, but they have to pay some tax. If you put it in the fund first and then you sell, you avoid the capital gains that the individual would have otherwise paid.
Okay, great. Excellent. Thank you so much.